Just put your money in the stock market. Stocks go up and down. Be diversified. Invest for the long term. You don't have a 401k? Put your money in a 401k. Time in the market is better than timing the market. Everything goes up over time. Today we are going to get into things that people say about the stock market that is just things that they've heard on the back of a pamphlet. We're going to challenge all of those famous sayings and, give both sides to the story, because I think a lot of people talk about all the good and just trying to force you into a market, but don't really think about why they say these things and what's the other side of it. So please be sure to stick around for all that and more. It's Crystal with the Cash Compass. All right, welcome back. I am here to teach you everything that you should have learned in school about money, but for whatever reason, they forgot to mention it. Please be sure to subscribe because we talk about everything from personal finance to investing to the economy. Let's get into it. All right, so I want to address these things one for one and get into a little bit more of a breakdown about why I think, you should just be throwing these sayings around because they're not necessarily true. And let's start with when people start saying stocks go up and down, just buy and hold. Well, yeah, no they go up and down. We all know what goes up must come down. That is not necessarily comforting. And I've said this on my channel before, but it might be lost somewhere in between stimulus packages. But basically, there is no money heaven, right? There is no money daycare. When your money in your stock portfolio goes down, it's not because it's just on vacation, it's because it's in somebody else's pockets. And I think when people say it goes up and down, they don't understand that what's happening is really wealth transfer. So what you're really saying is, I'm okay with somebody else being smarter than me, being more active than me, and actually taking my money because eventually I will make money later on. And while that might be true, like eventually you will make that money back, hopefully, but why not try to be as active as you can be and not just buy and hold? And I do want to explain what I mean by a wealth transfer. When you're buying a stock, you're buying it either directly from a company or more likely just from something like within Robinhood or some sort of investment account or investment app that allows you to trade between people, right? So when you bought it, if you bought it at $50, you gave Joe $50 for the stock. Now it's only worth $30. Well, your money didn't go to heaven, like I said. Joe went away with your $50 and now all you can get is $30 for it. That's a wealth transfer. You have made Joe richer and made yourself poorer. And of course it's going to happen. That's natural. People are going to lose money. But if you are more active with it, you can definitely dramatically reduce your losses. Thinking it's going to just be all right later is not necessarily the best plan. I mean, ask people who were retiring in 2008 how that went for them, right? When they said, we're going to just buy and hold. And then when it was time for them to retire, half of their savings is gone. Another thing is that I think people try to segregate money. So it's like, oh, this is my retirement money, so I can just kind of set it and forget it. But you wouldn't do that with money that you need on a day-to-day basis, right? So if the money you had, you needed to eat, you needed to pay your bills, you're not going to say, yeah, we're going to just hope for the best. No, you're going to be very active in that money because you absolutely need it. And eventually you will absolutely need your retirement money. So you should treat it the exact same right now. And I think a better mentality, and obviously you do what's best for you, but I think what works better is maybe setting up a threshold and being active in your accounts. So it has to be a realistic number, right? So let's say, okay, if my portfolio goes down below 10%, then I'm going to pull my money out, reallocate, kind of look at what's going on in the market, and then we can adjust as necessary. For you to just say, I'm going to forget about it and just pray that it's all right 30 years from now, I think is a little bit lazy. Yes, I said it. I mean, you want to be careful about saying things like that because anything that you half-ass, you're going to get half-ass results. The people who probably invented that saying, I don't know who invented it, but I guarantee you it's somebody who benefits off of selling people stocks, number one. And number two, I bet you they are not having that same kind of mentality. People who are super wealthy do not just forget about their money. They are extremely active. They're telling you to buy and hold, but they're getting out. Look at how many CEOs have been selling their stocks. I mean, these people are in the know. They're very knowledgeable and they're very in tune with their money, okay? They're not. There's no way you'll see people like that who are super wealthy just forgetting about their money and coming back to it 30 years from now. So you shouldn't do it either. On top of that, stocks are heavily manipulated. You'll see the Federal Reserve, when they started buying up assets, and of course, they quote unquote can't buy stocks directly, but it's a pretty good correlation. You'll see that when they started going crazy and buying up a whole bunch of assets, the stock market also quite coincidentally went up too, right? No, it's not a coincidence. You can believe what you want. You can do all the research on your own, but these markets are manipulated. So for you to just kind of sit around in a market that's going to constantly be changing, I think you're doing yourself a dramatic injustice. All right, the next one is to be diversified. And if you've ever worked within your 401k, maybe you spoke with an advisor, you had some sort of robo-advisor, but they'll tell you, oh, you should be diversified. And when they say diversified, they normally mean, okay, we'll give you a little bit of stocks here, a little bit of bonds there, and boom, you're ready for retirement. But diversification is much more than just stocks and just bonds. You have to think about a whole bunch of different factors. I mean, obviously in this current pandemic, which is worldwide, not the best example, but maybe there's other sectors, other countries that you can consider putting your money in. And obviously this requires a lot of research. You're just not going to pick a country on the map. But in the event that the US stocks might not be performing well, is there another country that might not really operate so heavily under the US umbrella, which is a little bit hard these days? But you can find countries that, can kind of hedge against your risk. You can also be diversified amongst different industries, right? So you'll have healthcare, you'll have food, entertainment. So you kind of not keeping all your eggs into one basket, not just buying a stock because you like Uber or you like, I don't know, McDonald's or something like this, but really thinking about how these companies operate. But also, like I've mentioned on this channel, diversification is not just in intangible assets. You cannot touch a bond, you cannot touch a stock, you cannot have any control over what those companies do. If they make decisions that investors don't like and people want to rush out of those stocks or they file bankruptcy, I mean, you really don't have any control over those things. So I think it's important to also consider things that are in your possession, things that you hold, things that you own, not only stocks and bonds, things that are pretty much invisible and created, but things like gold, physical assets, real estate, having your own business that you can be in control of. Because if you're in control, you can kind of pick and choose how much effort you're going to put into it and kind of be more innovative. Whereas when you're just buying shares of a company, technically you own it, but normally the average investor does not own enough stocks to actually make any life-changing decisions in those companies. So you really want to hedge your risks as much as you can. If you're just all in on any one asset class, I mean, we can see right now how that could have been quite unfortunate if you were all in on Airbnb, for example, and now, your listings have dropped like 90%, maybe even 100%. So you want to think about diversification as, what can go wrong and how can I hedge that risk? And obviously in a situation like what's going on right now, everybody pretty much got the beat down. So it's not guaranteed, but at least you can mitigate it in the best way. The next thing is invest in the long term. Don't invest for short term. People make money at every single point in the business cycle. People make money day trading. People make money keeping it in there for the long run, which is true. But you have to invest when investing is right. There is a time and place for everything, right? So might not be the time to invest if you see stocks are falling 10, 20, 30% within a matter of a couple of weeks. Like I said before, set a threshold and maybe say, okay, I'm going to get out and kind of wait a little bit, let the dust settle before I get back in there, okay? If you were going by the ideology of, okay, I'm going to just buy and hold, if you set a threshold at 10%, you could have pulled it out at 10, and then maybe when you saw things kind of picking up, you could have got back in there. So the stock market in March fell 37%. If you got out at 10 and maybe got back in while things were accumulating back up, well, then you could have prevented 27% of your portfolio from going down, right? Because you would have pulled out before it got down to 37%. So I think you have to invest when investing's right. You have to be extremely active. You can't just say, oh, this is long term. I'm not going to need this money right now. Because you don't really even know that. A lot of people lost their jobs, right? And if they had the ideology of, okay, I'm going to set a threshold. If it goes past 10%, I'm going to pull my money out. And if they lost their job, they can just say, you know what, whatever. At least I pulled my money out at this 10% mark. But if you lost your job and your stocks fell down 37%, well, that's a bad day. And even if you don't want to pull it all the way out of the stock market, you can just reallocate. You don't have to just kind of pull it out and keep it in cash and be afraid. No, you have to just be educated. All decisions should be backed by education. It shouldn't be backed by what somebody told you was a good idea. Oh, it's a great idea to get a 401k because you get employer match. Okay. But if you don't know what you're actually investing in, if you can't even name a stock or a bond or an ETF, if you can't name not one thing in your portfolio, is that a good idea? I don't know. But I don't think so. And speaking of 401ks, the next one is put your money in a 401k so you can get employer match. Again, it's something that is thrown at us because it sounds good. People say, oh, you got a 401k? Are you balling? But a lot of people don't have any clue what's going on, like I already alluded to. So being properly educated and putting your money in things that you understand, to me, is more important than just having a 401k because people say it's a good thing to have. If you don't even really know what's going on, why would you want to put your money in there? If you think it's too intimidating to learn, then go learn it or go do something else with your money that will make sense and that you can actually be active in. And I've mentioned this on my channel before, but the 401k was never invented for a retirement account purpose. Pensions and your social security were supposed to be for retirement. But what they found out was, you know what? It's actually more affordable for us and more lucrative for us if we don't guarantee you anything. With a pension, you get a guaranteed amount of payment. With Social Security, you get a set amount of a payment as well. With a 401k, you put your money in there and you just better hope that you get something out, right? They'll give you pretty charts and they'll show, yeah, like, look, over time, everything has been great. But you're not really guaranteed anything. If you end up retiring during a recession, well, guess what? If your portfolio got cut in half, that's on you. These 401ks are pushed at people much more because it's much more easier to just charge you fees, extract money from the middle class and from the poor, and put it in the pockets of the rich. That's just a fact. So you can go on the US debt clock and you'll see, I think it's something like 1 or 10% of the people up top have more than 50% of the people on the bottom. So you guys, I went to go get an updated screenshot of this, but they actually removed this information. So this screenshot is from November, and it was actually the top 1% compared to the bottom 50. So you can see the dramatic difference. And unfortunately, I don't have any updated numbers on this. That is really crazy, and it happens because of things like this. So I'm not saying don't get it. I'm not giving anybody specific financial advice, but just be educated and understand what's going on and play the game too. If they're playing it, we gonna play too. And again, with 401ks, I've said this before on my channel, but it's definitely worth mentioning again. So let's say you have your 401k and you have your stock portfolio outside of your 401k. Even if you invest in the same exact things, it's going to be taxed differently and much higher in your 401k than in your portfolio outside of your 401k. When you have a portfolio outside of a 401k and you have the stock for at least a year, it's considered capital gains. Any money you have made off of that, at least at this current year, can be taxed at a maximum of 20%. Whereas if you have your 401k money, that's considered ordinary income. You could have had that money in there for 30 years and every dollar is still considered your ordinary income, and that can be taxed at a maximum of 37%. So you can see that if you just do it on your own, you can have the potential to save 17% of that money that you've earned back in your pockets where it belongs. The next one is time in the market is better than timing the market. I think we need to define what timing the market is. A lot of people will tell you, oh, don't time the market, just jump in head first. But it's like, I'm not timing the market if I see things falling off of a cliff. I'm just using my eyesight. Boom. I can see that things are not doing well right now, right? I can see 30 million people have lost their jobs. I can see that the economy has literally grinded to a halt. So nothing is motivating me at this moment to go into real estate or other investments. Right now, I'm just trying to see and wait till the dust settles, because if you've been watching my channel, you know I don't believe that we're just getting started, really. We're honestly just getting started. Once the dust settles, even when people start going back to work, it's going to be dramatically different. I mean, you see how states are opening and they can only have like 50% capacity, even like a 30% of capacity. So it's like, you know, things are not going to be right back to normal like I think a lot of people think it's going to be. So am I timing the market because I'm saying I'm going to wait? No, I definitely think that because there's so much going on, there's going to be downward pressure on certain assets that you can take advantage of. So it doesn't necessarily mean you're trying to time it because you think it's going to go down. You're just taking an educated guess. And I have great reason to believe that we will be seeing decreases in real estate. I think we will be seeing decreases among a couple of different asset classes. So I'm going to just wait. And that's because I've actually put education behind this thought. I'm not just making it up or pulling it out of a hat, right? So timing the market, yes, if you're just kind of being speculative, of course. But if you have backed everything that you believe by facts and by research, well, if it goes the opposite way, at least you know you did what was most comfortable for you. And that's ultimately what's important. The next one is, oh, I'm going to just dollar cost average. And if you don't know what dollar cost average means, it just basically means that no matter what's going on in the stock market, you are going to just keep on buying maybe a set amount every single week. It doesn't matter if things have gone down 50% or have gone up 1,000,000,000%, which is not a number. But you're going to just keep on buying stocks, buying stocks, buying stocks, because when you average everything out, it might be at your target purchase price, right? So if you bought stocks at one stock at $10, one stock at $40, well, it's kind of like you bought two stocks at $25. So it'll kind of average out. And I do think that makes a lot of sense. I just think it depends on when you're using that technique. So like I said, in March, when things were falling off of a cliff, you probably could have just waited. I mean, if you see things dropping down 15% in 1 week, I don't know that I still want to buy. I think I'm going to just wait a little bit till the dust settles, and then we can kind of go back in and do this dollar cost averaging. And also, it depends on the company. You can't just do this blindly. Like, for example, let's say you work with JCPenney's and you're like, you know what, I'm going to just invest with JCPenney. I'm a dollar cost average, and, it doesn't matter what's going on. I'm going to just keep on putting a certain amount of money every single week. Well, you see how that turns out. Not the best, because now I think they're trading at around 25 cents. So not too good. If you dollar cost average, you would have been dollar costing you behind right to zero. So, use that technique when things make sense, when you believe in the company, when you've looked at their business model and their income and their earnings and everything makes sense. Then yeah, you can pull that trigger. Hertz, for example, a lot of people went into Hertz because they saw the price has plummeted. And guess what? Hertz has plummeted. They're filing for bankruptcy. So obviously, they said they're still going to be going on. They're not going to actually throw in the towel completely. They're doing a Chapter 11 bankruptcy. But obviously, that's not good news. So you want to be very careful with what you're buying. All right, and then let's talk about this one. Stocks go up over time. So stocks do go up over time, of course, but so does inflation, okay? And you can't just look at stocks by themselves. If you go into somebody like some sort of financial advisor, they're going to show you charts and everything is just looking great. Like, look at this chart. Over time, it's just going up, up, up. And we want to see that, right? We like to see green arrows. But Venezuela had the highest performing stock market for years. Their stock market was going up all-time highs year over year, and it literally dropped, straight down, 90-degree angle down when they had to reset their currency. So just because stocks are going up doesn't necessarily mean that you are making more money. You have to look into inflation. And if inflation is performing better than your stocks, well, then you're out of luck. Because in Venezuela, again, when their stocks went up, inflation got so crazy. It was to the point where 1 week of earnings couldn't even get you a loaf of bread. So your portfolio, even if it's doing amazing, inflation can eat into that. So you don't want to just look at things one-dimensionally. You have to evaluate the whole kind of, economic world before you make decisions and just think that you're doing well because you see positive returns. All right, that will do it. If you like this video, then please like this video and share with your friends. And if you have nothing else going on, you know what to do. Binge watch me. And until next time, keep your money up.